Hello. So, might need a little bit of reinforcement for this one. I want to talk about cryptocurrencies tonight. Maybe you've heard of Bitcoin, maybe you've heard of other things. Maybe you've heard people saying, it's a bubble. Oh my God, it's a bubble. Well, if you think it's a bubble, you're probably right. It is a bubble. But the question's not particularly useful. Better question is, what kind of bubble is it? So, I think it's a technological bubble more than it is just some financial Ponzi scheme or something weird like that. Maybe you remember back to the days of the dot-com era when we just invented the internet, and people were going crazy over that. And what happened there was that we'd created this network, and we'd connected all these people together, and the prospect of having the whole world connected together like that seemed like an amazing idea, and it seemed like there's got to be a way to make money out of that. Somebody thought, lots of people in fact thought that, and they set about doing that. And that was the great flurry of the dot-com era, the bubble as such. It was a technological bubble, an innovation bubble, because a key transformational technology like the internet meant that we were in new territory. People didn't exactly know how to exploit that. They didn't really know how things should be, so they had to explore. When people explore, they go wide. That's the bubble. And so a lot of things were tried, and in the end, of course, everything came sort of crashing down. They had the dot-com crash, and that was really just a flying apart of all the things that didn't work, leaving us with the things that did. And out of that we came with what did we have? We had Google and Facebook and a whole lot of things like this. The stuff that's left over is the stuff that worked, and everything else goes by the wayside. So the bubble is a great exploratory research and entrepreneurship that goes on when a brand new technology appears. Now, in the case of cryptocurrencies, there is indeed a brand new technology that has appeared. Underpinning all this, there is this notion of a blockchain and some similar technologies. You see, when we had the original just internet with web browsers and such like, when they were trying to make applications in that space, what they quickly found was that you could make applications and you had free for all and just making whatever application you liked, but it was very hard to make money front and center as a part of your application, because the way that we did payments, the way that we did money and transfers just didn't fit this whole notion of everybody connected to everybody on an internet. I mean, what are you going to do? You're going to slap down your credit card and hand it over to some random stranger on the other side of the planet and do business with them? You're not going to do that. The fundamental trust mechanisms around credit cards and so on are designed for a world where the two parties engaged in it, the retailer and the consumer, actually have some kind of a trust relationship because they're in the same community together. You go down to your local supermarket and they've got bricks and mortar business there. Their business relies upon their reputation. They have a lot more to lose by defrauding you than you do by being defrauded. Because frankly, it would destroy their reputation and their business, and they'd lose millions. So this is the basis upon which we actually trust each other with the credit card style payment. Now, by contrast, if you pay money to another person using a cryptocurrency, you don't share anything. If I had some Bitcoin, say, and I wanted to pay you that Bitcoin, then I would just ask you to, show me an address, and that's just a big long string of digits, actually hexadecimal digits, but you send me this code, and I push money at it, and that can be just a one-time thing. I mean, the worst possible outcome there is that someone else intercepted that and accidentally paid you more money than you were expecting. How awful would that be? So that's sort of what it comes down to. It's a change in the way that we do trust around money. There is no trusted central authority. That's one of the first characteristics about cryptocurrencies, is we're trying to avoid trusted central authorities. And this is a sense in which it is most fundamentally different and in fact revolutionary. What we're seeing at the moment is the early days ramp up on the curve of the change that I would expect to see as a consequence of this innovation. Let me just lay out some of the things that I would describe as being wrong or different with existing currencies, and then how is it different with cryptocurrencies. I've got some notes down here I'm going to refer to a little bit, so bear with me. The first thing, I think, as I've already mentioned there, is the existing monetary systems are based around this concept of a centrally trusted institution, a bank, the government that issues the currency in the first place, the bank that holds your money and cares for that and gives out loans and tries to be very conservative with it all and so on, to manage it well, you'd hope. Although they have somewhat of a reputation of screwing up. I think we're all still paying for the 2008 GFC bailout to the tune of some trillions of dollars. Another characteristic of the existing payment and money system is, in a lot of ways, it's what I would call vendor hostile. If you are a vendor of goods, if you are a merchant, and people want to buy things from you, and you take credit cards because that's the common convenient way to pay things today. And what happens right there is that, well, for a start, they've got a giant middleman in the form of Visa and MasterCard and the bank and whomever between them and you, the customer. And when you go to pay them, well, maybe you were not totally honest, and you were doing a fraudulent transaction because you were using a stolen credit card. They don't have any way to really know that, and they may take these credit cards anyway, and then money is lost. And essentially, the cost of fraud falls onto the vendor. The bank provides them with some kind of insurance around that, because the bank has a broken system, and then insist that the vendors take out insurance against their broken system to cover the cost of fraud. So it's a great system if you're the bank. Not great if you're a vendor. Of course, meanwhile, the banks also have delays and so on while the payments get through, so the vendor doesn't even necessarily get their money for some time. It may take a while before they actually get their money. So they have delayed money, they get defrauded, and they're charged high fees for the privilege of it. Essentially, the problem in there is a sort of a systemic architectural problem in the design of the payment system. The vendor cops the cost of the problem, while the banks are the only ones who could actually do anything about it, and all the credit card vendors. So the cost doesn't sit with the right entity in this arrangement. So that's fundamentally sort of designed badly. And it relies very much on this sort of centralized management of secrets How many times have you heard lately of millions of credit card details having been stolen in some hack attack somewhere, and oh my God, everybody go and change their credit cards and so on. How many of you have found that one day your credit card, through no fault of your own, was suddenly being used to buy an airplane ticket for somebody in Uzbekistan or something, and you had to cancel your card and somehow claim this back and convince the bank that you really weren't in Uzbekistan. This is the effect of a system that's broken by design. It was okay once, but it doesn't fit the modern age, very international age. Now, the other thing that characterises the existing monetary system we have is that the kind of jurisdictional boundaries that surround money are all geographic, nationally based. So if you want to do anything internationally, then you've got whole new hoops you've got to jump through. Every different country has different rules and regulations about how you can do business with them. They'll have different tariff structures, they have different payment systems, and there's these middlemen out there in the form of companies like Swift that sit there actually between all of the banks, and they charge an absolute fortune. So you try sending any large amount of money internationally, and you find that it takes days to get through, and they charge you a bloody fortune for the privilege, and they're a monopoly. So there's that. The other thing is that increasingly, as things are digitized, as we have digital photographs, digital audio, digital video, digital everything, we find that the digital assets don't kind of bind well to the notion of traditional money. And so we find ourselves in the midst of the copyright wars, where somebody claims ownership of a thing, but there's no real record of that. They just claimed it. And we've got some pretty hostile legislation in the form of things like the DMCA in America, the Digital Millennium Copyright Act, that actually lays out a situation where any media organization, like say YouTube, who allows people to put content up and to play that, to maintain their status as a free sort of conduit for media content like that, they have to support any copyright claims that anybody makes. So they get takedown notices that get sent to them. They have to support them immediately by just taking down the content, whatever it was. That all sounds well and good if you're a content provider making legitimate claims that someone's stolen your stuff, but there's no checks and balances on this, and it's very hard to do because there's no basis for deciding who really owns the thing. And so the result is that people can just send a DMCA notice against anybody's content that they don't like. You simply go, I don't like their video. I find their video offensive. I don't like what they're saying politically, perhaps. I disagree with them. So I'll have their video taken down by lodging a DMCA notice. And then they have to try and fight to get it put back up and try and prove their innocence. That's quite disruptive. All this really because there is no registry of the digital assets, who owns these things in the first place. And the system of payment for these things also rather sucks. We're left in this situation where, if you imagine that the internet is really a giant copying machine, right? It's the thing it does best is copy stuff. But the situation we're in is with digital assets, particularly music, videos, books, whatever. It's the distribution of these things is dominated by a small number of very large vendors. You get the Apple Store, Google Play, Amazon, and these distribution channels come to dominate the market. They sit there between producer of content and consumer of content, or digital assets that is, because they act as the payment channel, and they end up in the end making the bit that should be the easiest bit, the copying bit, the thing that the internet's really good at, the most expensive and most difficult part. And the distributor takes most of the money and gives bugger all to the artist, to the creator of the work. So this is not a great system. It's a system to have a monopoly that sits in the middle of it again. Just think again, relying on trusted central institution is a fundamental part of this. Now that's kind of a summary of what's wrong with the existing thing. For what's kind of right about the alternative, what happens under the cryptocurrency world? Well, going back through the same points but reconsidering them in light of cryptocurrency technology. Very first thing, instead of centralized trust, instead of relying on some trusted central institution like a bank or Visa or a distributor of content like Amazon or YouTube or somebody, instead we have a system of decentralized trust. And that's a pretty radical thing to get your head around at first sort of glance. But most fundamentally, the people that invented this, Satoshi Nakamura, was the original author of a white paper some time ago, back in about 2007, I think. But essentially, he solved this problem, this mathematical problem, known for a very long time as the Byzantine generals problem. It really is just a problem that if you are communicating through an environment in which you can't trust the messenger, you can't trust that the message you send will arrive safely and unchanged, and there's a lot of messages flying around, and among a distributed group of you, how can anybody trust each other in that environment? And Satoshi came up with a mathematical solution to that. And since he's done that, the interest in that sort of thing burgeoned quite a lot, and now there are, in fact, several solutions. But without going into the maths of it, what you essentially end up with is a large distributed ledger. So it's sort of like a database, excepting that it's distributed, and all of the participants have a view of that in their own copy of things that is, through means of cryptography and a lot of clever maths, eventually becomes the same as everybody else's copy of it. So all of the transactions that you do through this, when you're sending Bitcoin, say, from one place to another, eventually everybody agrees with it. And you may have heard that it's kind of a bit expensive with the way that the mining, the Bitcoin mining and so on goes in there, but so put that aside for the moment. What comes about is that to try and defraud that, to try and make the answer different than it legitimately should be, to try and double spend some money or to pretend that you have money that you don't really have, would require such an outrageously large amount of computing power that there's really no one on earth that could mount it. So that's sort of what's going on there. So once you create a system like that, and you can have distributed trust, it changes the very nature of doing transactions. There is no Bitcoin the company, there is no middleman, there is no bank, there is no credit card agency or whatever. There is just people with Bitcoin sending Bitcoin to other people with Bitcoin. It's kind of like cash, except you can store it in digital wallets and you can pass this stuff around. And Bitcoin's not the only flavor of that. Last I looked, there's well over sort of 5,000 or so variations on this theme. Bitcoin's just the oldest and the biggest of them. So that. It gets more complex than that, though. The first generation of these, the Bitcoin itself, was a relatively simple payment system. You could pay Bitcoin from one person to another. Right? They added some additional facilities to do things like escrow. You could have multi-signature type arrangements where, yeah, I have to sign a transaction and you have to sign a transaction, and only when we both sign can the thing go through. Actually, up to n of m signatures, you could say, well, there's 10 signatories and 8 of them have to sign. You can make ridiculous rules if you need to. And it all still works with the same level of security. Other systems, some of the newer ones, things like Ethereum, which is another sort of second generation cryptocurrency. Ethereum provides what they call smart contracts. It's a step above the basic payment idea. Still has blockchain, still distributed shared trust with a distributed ledger. And yet you can make whole business rules. You can essentially program on the blockchain. It's a fully Turing complete programming language on the blockchain. And that leads to some potentially very sophisticated business rules. You can have businesses that are not relying on judicial systems to enforce them, that can be multinational in scope, that can be between any participating parties, where the rules of their business, the agreement is totally coded. It's like coding the business rules into code and having them executed, and nobody gets to make their own variation of what those rules are. You all agreed to them at the beginning, and it happens that way. So distributed trust, vendor friendly, sort of vendor hostile. If you're a vendor and you're working with cryptocurrencies, well, actually I had a great personal experience with this. I went on to a cryptocurrency seminar meetup in town in Sydney. Was at a bar, and the bar guy and also owner of the pub actually accepted at the time, this is a few years back now, he accepted Bitcoin for beer. That was pretty good. So I took the opportunity to have a talk to him about that and go like, oh, why is this good for you? And it really cemented in my mind what was going on here. You see, his view was, the setup he had was that you point your phones at each other and they exchange the credentials. They're not the credentials. He, as the bar guy, puts up his little phone and it shows one of those square QR codes, like a barcode thing, and you point your phone at that and it knows what price he wants now, and you tap in the thing and say send that, and now you're sending some Bitcoin to an address that he specified. That will go straight through an exchange and actually appear as Australian dollars in his bank account like now. Now, for him, he was obviously just uncertain. As a very interim solution. He didn't really want to be holding Bitcoin because he didn't know much about what to do with that. But this exchange arrangement meant that he got his Australian dollars in his account now. And that meant that, fraud not really a possibility, because he already got the money in his account. He's got it now. There is no delay. There is no dealing with fraudulent, stolen credit cards or any of that other nonsense. He has his money now. So there's no delay in payment. The fees were about half of what Visa charges. And did I mention he's got his money now? And what's more, it's in his bank account, so he's not having to carry any cash. So he's not running the security risk of people maybe just coming and robbing the cash from him. So all round, he was pretty happy about that. So structurally, architecturally, that's much better, much more vendor friendly. Then there's the security aspect of this. I mean, you might go, how secure is this cryptocurrency thing? And the answer actually is really quite secure. Um, if you imagine the banks and the like, you think of them as being kind of secure, but they do get robbed from time to time. And they'd go to great lengths to sort of keep the outside world out of the workings of their systems. And there is inevitably hacks, there's inside jobs, there's all sorts of things that go down with that. And funny thing though, cryptocurrencies essentially don't get that problem. The blockchain, the thing that is central to the functioning of a cryptocurrency like Bitcoin or Ethereum or whatever, it's out there on the public internet, surviving all challenges by all comers, and has done since about 2007. The central protocols, the central organization and so on of the way the whole distributed ledger works has been under constant challenge in the public domain for a good decade. And the prize for cracking that, for breaking that, has been in the order of $300 billion of recent times. So that's quite a prize if you could break Bitcoin. And so the prize was huge, and a lot of people tried to break it. And in fact, it was this endless attempt by people to break it that hardened the whole system, that really brought it to the point where it really is robust and really does stand up against all challenges and doesn't fail. How many banks do you think would still be operational if they made all of their code public and made all of their computer systems open access on the open, on the free and open internet? I don't think any of them last more than about a day. Essentially, they don't have hardened code. They have code that relies on a small army of people surrounding it and keeping it safe. Quite a different situation. So the cryptocurrencies kind of have that on their side. The other thing is boundaries, jurisdictional boundaries. Whilst regular currencies are all divvied up by geographic boundaries, this is Australian dollars, that's US dollars, this is Great British pounds or euros or something. And there's all these boundaries to the world that contain these things. And trading across those boundaries is hard and is protected, and that just throws barriers in the way of cooperation and trade and entrepreneurial activity. Not great. Cryptocurrencies essentially operate without regard to that entirely. It doesn't know Indians from Australians, from Americans, from British, from Europeans, from Chinese, from Russians. It doesn't care. If you have currency, you can exchange it with other people for goods and services, and you can do your thing. This is actually kind of marvelous at a certain level, because in the world today there are somewhere in the order of about 4 billion people who are essentially unbanked. They are excluded from the economic systems that you and I take for granted, essentially because they're not profitable. And so they don't get to engage in commerce the way that you or I do. They don't have the security of a bank, of a credit card, of a whatever else, and launching into business is a hand to foot sort of business. It's very local, it's constrained to the people you can walk to, and that limits their ability to sort of lift themselves up by the bootstraps. So the boundary systems that we have today are in fact a great limitation. Now, in a related effect, one of the other big differences is in relation to innovation. When you have these boundaries, one of the follow-on effects is that you want to innovate in any way, you have to ask permission from the gatekeepers today, right? If you want to do anything a little bit funny in the way that you exchange money or interact with organizations international, people in other countries and so on, then there's all these people you have to get permission from to do this, and you have to follow all their rules, and you know, well, very similarly to the way that the network worked for when they had the whole .com era and when the internet appeared. The great fundamental characteristic about the internet that drove the innovation on the scale that it was this principle called net neutrality. They're fighting about this in the US at the moment. Mr. Trump wants to stop it, apparently. What an idiot. Anyway, the central premise of that is that all participants participate on an equal footing. And this means that anybody with a bright idea that jumps up and goes, oh, there's a great new idea for an application. All I have to do is code it and launch it, and everybody can use it, and if everybody likes it, I'm a winner. Yeah, so it's what they call permissionless innovation. And that's a really important concept. Permissionless innovation is what drove the absolute rampant development of the internet as we've known it. And now these cryptocurrencies is very similar, only now it's they call words Internet of Money. So together, Internet of Money. Cryptocurrency is the Internet of Money. And in this, you now get to have permissionless innovation around monetary affairs. If you want to create your own bank in this world, you can. I mean, you raise a child today in the current things we all grew up with, and maybe at some point your child reaches an age where you think, maybe you discuss with your significant other and you go, oh, at what age do we give our child, let them have their own bank account? Well, in the future, next generation of kids that grow up, the question is going to be subtly different. It's going to be, what age will we let them have their own bank? Because that's what they'll be able to do. Because they'll just download and run an application on their smartphone, and it will be whatever financial system they want. And so long as they can operate it, and most of it will be automated, they'll be able to do that. And there are no particular restrictions to this. It's not regulated. It's a matter of consensus and agreement and collective activity and behavior and distributed trust. So that's a pretty significant change. And that's what's central to this whole cryptocurrency craze that you see going around you is and I'll talk about this a bit more further in, but what we have out there is rampant innovation. It's everybody trying to figure out what to do in this new permissionless, innovative money of world. Money of world, world of money. That makes more sense. So there's that. Now, the other thing is that unlike the traditional money, the Australian dollar or whatever else, and there's a peculiar little twist to get your head around, digital currencies, cryptocurrencies, are in fact digital asset centric. They are oriented around that very notion. See, in fact, this is the little twist in here, is that currency is just one application. It's one type of digital asset that can be managed by these systems. It's the most obvious one. It's the one everybody jumped onto because it worked, because we could do it now. But by the same measure as you could have currency as the asset that you are managing with a blockchain, you could equally well have music, digital music, or photographs, or audio, or books, or any kind of digital asset could equally well be managed on these blockchains. And the concept of ownership of those things works just the same. So in the same way that you can be the digital owner of a Bitcoin, you can be the digital owner and manage the rights of a book. And once you can do that, now there would in fact be a global registry of ownership, and it would be immutable, it'd be unchangeable, unless you did a transaction to say that it's now owned by this other person because you sold it to them. These sorts of notions suddenly apply. So that's kind of exciting. That means that we could potentially eliminate those distribution bottlenecks and just let the internet do what it does well, which is to say, copy things. So, where to go from here? Talked about distributed blockchain for other assets, blah, blah, blah. Here we go. So, how does the marketplace for these new things pan out? What's sort of out there? What's going on? How does it look? At first glance, you might just think the cryptocurrency market is really just assorted different payment systems, and to some degree it is, but it divvies it up as the whole market divides itself up around functional bases. So yes, there are a few simple payment systems. Bitcoin, the most well-known one of them, is a very secure system, and people make payments that are equivalent to hundreds of millions of dollars through Bitcoin, and they do it securely. So that's great. Bitcoin has some scaling issues. The rate of its use has gone up. It's hit some scaling limits, won't process enough concurrent transactions, and so it all slows down. And then if people want to get their payments through, they have to sort of pay a higher fee. So the fees to do Bitcoin transfers have increased. It used to be zero when I first started playing with it. Now the fees have increased to the point where, like over the Christmas break, when it was absolutely frantic, when things were going crazy with Bitcoin, the fee to transfer some money through it could be in as high as the equivalent of sort of 20 to 30 odd Australian dollars. So that was a bit excessive. It's reduced a bit since, but either way, it wasn't great. You certainly wouldn't buy your coffee with that. But given the gross, really high level of security that comes with that system, the incredible robustness of it all, what it seems to be emerging as is, I think someone from Goldman Sachs coined it as being the digital gold. It's a store of value. People treat it as a store of value. If you've got a large amount of money that you don't want to have in somewhere else, that's if the markets are going crazy or something, you move it into Bitcoin and store it there, and they expect that eventually, I mean, it's a bit volatile today as well, but the volatility will go away over time as the market for that settles itself out. They already have futures markets and other things like this going on, so that should settle with time, and eventually it might emerge as a store of value, a value store. There's some interesting comparisons there, actually, as a value store. It's actually the Bitcoin system itself is modeled on the way gold works. And there's a high cost of mining gold in the first place as a scarce resource. There's only limited amounts of it, and the cost to mine it gets higher and higher over time because there's less of it just lying around. So the mathematical cryptographic system of Bitcoin sort of models that. So there'll only ever be about 21 million Bitcoins in the world, and the amount that can be mined through this cryptographic mining process diminishes over time. Eventually, at some point, in still a few decades away, I think, there will eventually be maybe 21 million of these mined, and no more will ever be created. So the supply side of this is fixed, and the value of it is entirely based on demand. So it may go up and down in relation to how much people want it at a given time, but that should be manageable, and futures markets and things like this can be used to manage the cost demand for being purchased or required at certain predictable prices and these sorts of things. So all that can be done. So that's sort of where that's heading. There are other straight up just payment systems like Litecoin, Bitcoin Cash, a few others like this that are really just straight up payment systems. They're more lightweight. They happen more quickly. They have much lower fees, talking a few cents. So you might indeed be able to just buy your coffee with Litecoin or something, and that would work. The competition in that space is, I think, mostly about marketing and engaging with other external vendors, so that you might one day be able to use Litecoin pretty widely and use it to buy your coffee, use it to buy your clothes down at the supermarket or wherever, those sorts of things. So that could be quite good. And it's more to the point, using it to buy things over the internet when you don't necessarily trust the person at the other end. So there's that. So transactional things. There's a few others, a couple of others that I would say are still transactional, but on a different level. The system's called, one called IOTA, which is IOTA. IoT as an Internet of Things. It's about small autonomous devices on the internet, might be things around your house or whatever, and where they need to transact with other devices, possibly on the scale of micropayments, fractions of cents. Just imagine, for example, you've got a solar panel on your roof. It's generating power while the sun is shining. You're not at home, you're not using that power right now, and your system could be trading some of that power for someone else's household that needs the power right now, and so they pay a few cents to your thing to take the power that you've just generated and weren't needing. That's the sort of thing you could just do with IOTA. It's slightly different internal design. It doesn't actually have a blockchain as such. It has a thing called a tangle. Since it's targeted at micropayments, the security demands are much lower, and rather than trying to have a completely distributed ledger where everybody knows all things about all transactions, they limit the scope of that and say, look, there's only a certain depth in which all this transactional data gets tangled outwards from its origin, and this trails forward through time. As long as you've got enough confirmations in there, then everybody will trust that that's the payment as it was really made and is only worth a fraction of a cent anyway. This one, by design, works out that the transaction fees are in fact zero. They're zero now, and they will always be zero. This is by design. Essentially, when you do a transaction, you pay for that transaction by validating other people's transactions. For every transaction that you want to be validated yourself, you have to validate two others. So that's the setup there. And there's other ones like that. There's something called Byteball. It's fairly similar. It may well be that for small transactions, the buying your coffees or whatever else, that this sort of system could end up being the winner there, just because zero transaction costs is quite attractive, and the amount of security you need around the price of a cup of coffee isn't much. So that could be quite good. There are other specialty payment systems, things like Verge, Monero, Zcash, a few others like those. In fact, they're what they call privacy coins. So they are payment systems, primarily still functioning as payment systems, but they are strongly anonymous. Bitcoin itself seems, let's say, pseudo-anonymous. There isn't any real identity tied to the transfers, but it can reasonably easily be associated. So please don't think of Bitcoin transactions as being anonymous. They're not strongly anonymous at all. They're quite easily tracked down, and governments have been engaging with businesses who make it their business to try and de-anonymize the transactions in Bitcoin. There are, however, things like Verge. Verge, for example, is strongly anonymous. they do like an onion routing system for the transactions. All the participants act completely unknowing about who the transactions came from and to. They don't even know the IP addresses of the participants. It's all hidden. So it's very strongly anonymous. So that's the privacy libertarian crowd getting involved there. There's a few other kind of microcurrencies around. You see things like Redcoin and Dogecoin. Dogecoin's kind of amazing. Its value is about 1 cent per Dogecoin. It was designed originally as a bit of a joke. It was an academic exercise in how to make a cryptocurrency, and somebody made one, and they made Dogecoin. It had a nice picture of a dog on its emblem, and it's a fun Litecoin to be enjoyed. That's about the function of it. It hasn't had any work done on it for 2 years. There's about 100 billion of them out there. The assumed value is about 1 cent each. No particular purpose. People seem to occasionally, pay each other Dogecoins in social media as a way of saying, "Hey, nice post." These sorts of ideas. But I did find that there was an actual use for Dogecoin that appeared recently on some of the cryptocurrency exchanges, where people wanted to trade in and out of some really micro currencies, very, very small, 20 fractions of cents, with a lot of them. And you need to have like a trading coin, a coin that you use to centrally trade in and out of these. And I think the exchanges were looking for a good answer to that, and some of them settled on Dogecoin as the central trading coin for microcurrencies because it made a lot of sense. It was a very stable coin. There was a lot of them, 100 billion or something, and they're only worth 1 cent each. And that meant that when you were trading through that for microcurrencies, you had enough sort of resolution in the size of the thing you were trading through that you could actually have fractions of microcurrencies, and that made sense. So that had the really weird effect that actually made the price of Dogecoin go up. And people were speculating fairly rampantly about why that was. Why is Dogecoin going up? It's a fun Litecoin with no particular purpose. Turned out it had a purpose. There you go. But then there's a whole another class of cryptocurrencies out there, which I would refer to as the smart contracts, smart contract coins. Now, Ethereum is probably the most well-known of those, and there's actually a very large number of other currencies that are built off of Ethereum that rely on its basic central blockchain structure and act as side coins off them and arrangements like this. But it's pretty big. It does have some scaling issues. It runs faster, it has higher transaction rates than Bitcoin, but not massively so. I think I forget what the numbers were, but somebody made a global distributed application on Ethereum not long back. CryptoKitties. Look up CryptoKitties in Google and see what you find. CryptoKitties basically broke the scaling limits of Ethereum. It was trading virtual cats. I don't know why you would trade virtual cats, but you can, and it makes Ethereum go slow when you do that. Most of 2018's development budget around Ethereum is about performance improvements to solve all those problems. At the end of that, it should be capable of doing more transactions per second than Visa. So scaling is just it's a programming problem. It's a simple matter of programming. It's a SMOP. There are other ones out there. EOS. EOS currently with a market cap of about $7 billion. That's sitting out there nipping at the heels of Ethereum, wanting to be the faster, better, cheaper, easier to code, more choices equivalent to Ethereum. Or wait and see, maybe Ethereum scales well enough that EOS doesn't compete. Maybe EOS jumps up and cracks the nut before Ethereum does and becomes the de facto replacement. It's seemingly program compatible with Ethereum. If you can write a program in Ethereum, you can write it on EOS too. So there's sort of that. There's another one. There's actually another thing called Neo. Neo seems to be the Chinese equivalent to Ethereum. Largely the Chinese government's been a bit anti-cryptocurrency, but I think they've been mostly anti the Western ones, and fairly similar to the way that they sort of have their own Google equivalent, they have their own Facebook equivalent and so on. They really want to have their own cryptocurrency equivalents, and that's Neo and an assortment of other surrounding currencies. It is a smart contract based system and has an assortment of sub-projects and coins that are sort of surrounding it, a whole ecosystem of solutions building up around that. It's doing quite well in the market as far as I can tell. So there's that. Then there's another whole class of functional, these things are all dividing out all different functional lines right away, that wasn't clear. So apart from the payment systems, the security systems, privacy coins, micro coins, these sorts of things, and the smart contracts, there's also another set of things I call these exchange coins. If you've got all these different currencies, you need to be able to convert from one to the other. And what we have today is a system of exchanges. There are some quite large exchanges out there today, businesses that have just grown rampantly to support this need to trade between different currencies. And it's a bit like trading stocks and shares and so on. You get on these things and people study charts and you look at all this stuff and you trade one thing for another, and it might be because you have one thing and you needed another, or it might be because you're speculating. Either way, you work through these exchanges. But it's coming about that exchanges, particularly in a largely global, unregulated market like cryptocurrencies, are sort of the weak point, if you like. They are the nearest equivalent we have in this new world to trusted central institutions, because people leave funds in the form of cryptocurrency on these exchanges. They tend to hold them there for a while they're trading around different things. If that organization goes bust, then you've just lost your money. You can hold the money in your own wallet, sitting on your own computer, or even just by storing the right values on a bit of paper somewhere. Funny little story there, by the way. If you looked at most of the spikes in the prices of cryptocurrencies, particularly Bitcoin and so on, across the years, you might start to notice a little bit of a correlation with some political events around the world. When there was a bit of a political meltdown, I think it was Cyprus, it was the first time Bitcoin spiked to around $1,000 in price, because people wanted to get out of a war-torn country. What do? You have cash with you? You get robbed. You take gold. That's even worse. Bank accounts don't really work. They've locked up all the bank accounts long ago. You can get cash out because people still need the economy to work. They need to buy and sell stuff to live. Prices go up. What are you going to do? How are you going to get your money out? Well, people tweet into this bright idea. They could just buy cryptocurrencies, Bitcoin. And the easy way out of the country with your Bitcoin was simply, if you could memorize a 12-word phrase, that's all you needed. You could take your Bitcoin out in your head, in your own memory. You could remember one word each amongst a bunch of you. You could just write these words down in a random bunch of places in some books that you carried with you, redundantly copied around the place. And as soon as you get out of the country, you're going to get access to any computing resources. You simply, at that point, just create a new Bitcoin wallet, enter these your 12-word phrase, and there's all your value, and you trade it back for whatever you want. So it really is boundaryless. It really is just sliding between the lines there. It's very, very hard to control. So, but we're talking about exchanges. And so there's a need to exchange between different fiat currencies. And in fact, I mentioned earlier how hard it is, expensive it is to trade between fiat currencies globally, all the boundaries that exist, but also between cryptocurrencies and between fiats and cryptocurrencies. So some of these coins specialize in that area. There is a thing called Ripple. Ripple's possibly less decentralized than people are necessarily happy with, but their business is to set up to do interbank exchanges internationally. They would disintermediate the sort of the international money transfer organizations like SWIFT that are out there today. They would allow banks to transfer money internationally between themselves with practically instantaneous settlement, only a few seconds, and vastly lower costs than they're currently incurring. So their whole business model is about getting banks to use Ripple code XRP to do international transfers in competition with the existing methods. And frankly, as soon as any even a small group of banks really take that on board and have the drastic cost savings that are likely ensue from that, all the rest of them would have to follow suit, otherwise they would be rapidly outcompeted. So they're currently running trials with big corporations like MoneyGram and a few other big banks out of Korea, Japan, Europe, and so on. So Ripple may someday soon do really well on that sort of front. You can probably imagine that's got to be worth a lot of money to somebody. This other one, XLM, Stellar Lumens it's called. That seems to be set up to be call it a decentralized exchange. So instead of having a centralized exchange where you lodge some currency so that you can trade it backwards and forwards for other things, instead you keep your money and your coin in your own wallets, and it gets traded through the central distributed exchange. So you retain control and ownership of your funds at all times, and we essentially remove the central institutions that were exchanges, the remaining centralized institution there, and you could trade between cryptocurrencies like that. And they're more focused on that. Yeah, there's even another thing worth mentioning probably is that if you look on some of those exchanges today, those centralized exchanges that we have today, an exchange like, say, Binance is an interesting one. They're huge. They grew crazy rapid. They originally were Chinese, and they moved out to Hong Kong. As China got a bit rough on these things, and eventually they moved out of Hong Kong, and now I think they're centered in Tokyo. Those guys push trades through for somewhere in the order of about $12 billion a day. They are growing so fast that they had to stop registrations for a while because they just couldn't keep up with the support levels with the number of new customers that they had wanting to trade currencies through their exchange. They started again recently reopening for new registrations, and they're only open for an hour a day, and they got 200 to 250 to 300-ish thousand new customers in that hour each day. That's the scale of this, is how fast it's growing. It's ridiculous. But they, like all the other exchanges, tend to have what they call sort of vertically aligned markets within their exchange. So they might have a Bitcoin exchange where you can exchange Bitcoin to and from anything else. You can buy and sell Bitcoin for a whole raft of other coin. They also have one for Ethereum. You can trade Ethereum for just about anything else. They have another one for their own coin. This is the other idea of an exchange coin. They have a thing called BNB, Binance Coin, and you can trade Binance Coin for just about anything. And kind of neatly for them, they arrange that if you agree to pay your trading fees in Binance Coin, then, which means you're going to have to hold some, then your transaction fees are halved, making them about 0.1%, which is kind of small, so that's good. But they always have these central coins, and it's interesting that you seem to get a certain amount more stability for these sort of trading coins like this. So, you know, Bitcoin and Ethereum and Binance Coin in that case tend to be more stable simply because people need to buy them to buy anything else, and to sell out of something else they have to sell back through those. So the demand for those is held high. A little bit perhaps analogous to the way the US dollar retains its value, because everybody has to buy oil using that. Maybe you knew that, maybe you didn't. So there's that. There's a whole raft of other fairly large, what they call big caps, large market capitalization coins out there, which I would say are more like general platforms. You could sort of think of, I suppose, Ethereum as being a general platform. It has a lot of facilities that go with that. But there's some others coming along, some of them with some quite extensive vision of what the future economics and financial systems would look like. One of them, Cardano, is it's an academic exercise largely. It seems to be run by a group of collaborating universities around the world. They have considerable funding as an academic from academic sources. Through to I think 2020, the last time I heard. They have some pretty grand vision. They have in mind that they would invent treasury systems and systems to maintain and manage the value of these coins, to give a continuity to that and stability to that. Lending systems, just every little thing. They they publish all algorithms. Everything is peer reviewed and published. All of their code would be put through these what they call formal proof systems. It's the sort of technology you apply when you're writing software to run a jumbo jet or to nuclear power station software, that sort of thing, because you need that it's absolutely bulletproof. So that's the sort of thing that those guys would do. It's a long-term project. One day it might change the way we do everything. It might just act as a reference platform. Who knows? It's being valued quite high purely on the speculation of the breadth of the thing that they're striving for there. So there's that. There's other smaller ones like this. I came across a thing called Waves. Waves is like a cookie-cutter economic system based on cryptocurrencies. It's quite peculiar. They can just stamp out another economic system, just copy-paste, and you've got one. Maybe change the icons or something. One example I saw of them doing that, there was a system, a coin called Toker, T-O-K-R, and the name will make sense in just a moment. What it was that maybe you're familiar, in the US in the last few years, several of the states in the US have legalized the use of cannabis, either recreationally or medically. And yet the federal government still doesn't approve. And since the federal government makes the banking regulations, it means that any organization that is legal according to the state that they're in finds themselves trying to run an enterprise in which they are unbanked. They don't get to have a bank account. And yet their state says that what they're doing is legal. So that's a difficult situation for them. But of course, in cryptocurrency world, where we have permissionless innovation, you can just create your own economic system, and so they do. Therefore, waves came along and cookie cutter type arrangement is just stamp out a new economic system. And so all of the participants in the cannabis industry in numerous states can now trade amongst themselves, buying and selling their equipment, their supplies, their seed, their produce, their marketing, their paraphernalia, their everything, not in US dollars, but in toku. And it has its own built-in rules and regulatory systems and reports and trading schemes and payment systems and everything. It's all just there at a copy-paste level. So that's kind of remarkable. There's another thing there called NEM. I mentioned earlier this notion that digital assets made more sense natively to the cryptocurrency world than they did to standard currencies. Well, NEM is another one of these relatively large market cap coins, several $1 billion worth of market cap, who they're very focused on the idea of digital assets that are not just currencies, and so they have a similarly sort of cookie cutter arrangement where there's interfaces that you can use to create your own coin, to create your own digital assets, and to register them in this blockchain and record them there and manage access, control, attribution, rights, everything else in relation to the digital assets of your choice. That's NEM. So their intention is, again, it's a platform. They want to create an ecosystem in which people can just do that. So that's probably enough. This is getting kind of long, but that's my broad understanding of what this whole space looks like. It's a rampant, burgeoning kind of new technological sphere in which you get to innovate without permission, where it's a internet of money. Currency as a concept is absolutely central to the applications that you build. Don't ask for permission, you don't need it. Security is inherent in the way that the exchange goes on. It sort of pushes it to the edge a little bit. You've got to manage your own wallets, manage the security of your own assets directly. Some people are actually just creating what they call paper wallets. Is just put those keywords on a bit of paper and store them in a bank vault somewhere. A perverse twist on the use for banks. Just store it as a document. There's a bit of that going on. Yeah, so that's probably all for today. If you like this, leave us some comments. I think I'll end it there.